Hello, everyone. Today on the final bar, my guest is Gary Dean from sentimenttiming.com. We'll talk about some big picture views of the S&P 500, how we should think about things going forward. Overall, we had what I'd call a digestion week last week, sort of processing the gains. Today, more of the same, spiking higher at the open, but then closing back sort of flat for the day. So overall, not a ton of direction, but we are seeing movement from places like financials and energy really exploding to the upside, up over 2%. Pretty decent day. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a snowy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action of the markets using charts, using the message of the markets themselves. I'm often bombarded by prognostication, a discussion, debate about where the markets may be headed because of fill in the blank, right? It should do this, it could do this. And in the end, what I've learned over my career of looking at charts is the charts tell you what actually has happened. You can't restate price action. This shows you where investors are voting with their feet, voting with their capital. And so tracking those trends, following momentum, leaning into what's working, leaning away from what's not working is a tried and true method of following, understanding market behavior and positioning yourself in line with it. Now, we have some great guests coming up on this show. Excited to talk to Gary Dean today from sentimenttiming.com. Tomorrow on Wednesday, we have Peter Brandt from Factor LLC. On Thursday, Ryan Dietrich, who's the chief strategist at LPL Financial. Coming up next week on Tuesday, the 23rd, Keith Fitzgerald from the Fitzgerald Group, a fellow Seattle area resident, giving us his latest take on the big picture as well. Let's get into our market recap. I do want to start with a poll. We always have a poll going on our StockCharts TV page. If you go to stockcharts.com/TV, you will see our latest poll on our YouTube channel, on social media. We also throw some polls around. Appreciate you taking the time to answer the questions because it helps us get a sense of what you're looking at, what you're thinking. It gives us something cool to talk about at a moment like this. And the question we asked you just recently, what would you feel most comfortable shorting right now? We gave you four choices: stocks, bonds, gold, or Bitcoin. And basically a 50-50 split between stocks and bonds. Both of those got about a third of the respondents. The stocks in the form of the SPY, bonds in the form of the TLT. 24% of you said Bitcoin, 12% of you said gold. So a couple observations on this. Number one, it's fascinating to me that the S&P 500 making new highs again, today, making a new all-time high yet again. And then I'm looking over here at the TLT, which is in a raging downtrend. And both of those are getting an equal number of responses, which is just fascinating to me. So, obviously some of you thinking, wow, this is the beginning of something much deeper. Something like the TLT can continue to go lower, which means, higher rates, lower bond prices. But then others are looking at something like stocks and this, assuming that this is overheated. It's gone so far and it's been in this euphoric state of sentiment that at some point it has to revert lower. But interesting that both of those sort of got an even response. As a contrarian, I'm immediately drawn to GLD, which only got 12% of the vote, which immediately makes me think maybe there's something there. Maybe that's the short because no one's paying attention to it. I forget who it was that said the goal of investing is to have everyone agree with you later. So maybe short gold is the play. And it's interesting if you look at the chart of the GLD and you look at the chart of the TLT. So you look at gold prices versus bond prices. They're not that far off from each other in terms of the downtrend characteristics, things like stocks, like biotech, like, global markets, a lot of these just in consistent uptrends, cryptocurrencies as well, these long-term uptrends showing consistent appreciation. The real differences are things like the dollar, like gold, like bond prices, all sort of in these established downtrends. So maybe gold below 165, the GLD below 165 may be the play there. I did not answer this one. If I had to answer it, I would probably have said bonds and agreed with the most common response, the TLT, only because I see further upside in rates, downside in bond prices. I think that's a decent play in the short term, but that remains to be seen. Let's continue on with our market recap. As I mentioned, in the introduction, overall, this is sort of a further digestion period. I've thrown that word around a lot, and overall, what that just means is you have a period of appreciation. You need to kind of cool off and digest things. Friday really rallied into the long holiday weekend, so it was a nice closed at the high of the week on Friday, which was a nice way to wrap up the week, nice way to start the week. Moving higher, nice way to end the week. Today, giving a little bit of that back, but still overall essentially flat for the day. It wasn't a big movement day. Where did we see movement? So mid caps and small caps did come off a little bit more than large caps, but not by much. It was still less than 0.5% on both sides. The VIX back above 21 to 2144 or so. Some other asset classes, bonds really the weakest of the bunch, with the TLT down 1.5%. Now this is again, a move like that seems severe. It seems like a big move to the downside, and don't get me wrong, it certainly is. But I think there should not be a surprise on the fact that this is the latest in a series of steps lower. We've seen weaker bond prices. We've seen higher yields. The 10-year yield, just touching 1.3% now. And this is continuing to push higher. We talked about moving up to 1.4, 1.5%. I've heard people talking about 2% plus and to go into the 2 handle on the 10-year. That's a long way from 0.5% where we were not too long ago. But again, I assume as a trend follower, the trend is in place until proven otherwise, and the trend has been lower bond prices. Also weakness for gold. You see the gap lower this morning, bit of a bounce higher, but then gave all of it back to close more toward the lows of the day. The long-term uptrend in commodities, however, remains pretty much in place. You can see energy was the #1 S&P sector today. Oil prices up pretty good today. Other, energy components to something like the CRB up as well. Things that were down were precious metals, gold, and silver, usually perceived as more defensive plays within the space. Cryptocurrencies, for the most part, down. Bitcoin was the only one higher. Over the weekend, it touched 50,000, got above 50,000 for the first time ever. So clearly the path of least resistance on Bitcoin has been higher. Again, these are not huge moves to the downside given the volatility we've normally had, but everything else pretty much down today. Let's look at a chart of the S&P 500 and sort of orient ourselves with what's been going on here. We're going to look at this period a little bit later during our mailbag segment. I got a great question about the September through November period and just how to think about that. So I'll save that for now. But what I did want to point out is since the October low, since the rally above sort of out of this congestion area, the break above 3,700, 3,650, which got us above the September peak, we've then been in a pretty established uptrend. The most glaring moment of weakness was at the end of January when we pulled back to the 50-day. We closed below it one day and then reverted back to the upside. And since then, we've continued to make new all-time highs in the last 2 weeks. So again, I mean, my general sense is you assume that the trend is going to continue until proven otherwise. A lot of ways or a different way I might say that is the path of least resistance is higher. I think that's still the case for stocks. I could list out a lot of reasons why stocks are overbought, why they're overextended, why sentiment is euphoric, why breadth has been extreme to the bullish side. All of that at some point has to revert lower. But again, until we see the market actually turn lower and establish some sort of downtrend, the trend is positive. And I think the pullbacks we've seen recently have demonstrated the resilience of the market, just continue to push higher highs, higher lows. So, how do you tell that this trend is still in place? I think it's on the next pullback, right? And just like with this one, we held the 50-day, we held these previous lows. Again, I was a little concerned. We broke below the trend line. We broke below that swing low from mid-January. We never got below the 50-day. So if and when we do pull back, I'm looking at the 50-day moving average, just as we've seen previously, that holds. Overall, we're in good shape. That does not hold. You have to start looking a little deeper and think about potential for further downside. As I've said before, I don't know if we're going to get through this year without retesting this 3,200 to 3,250 level. I still think that's the case. And, I'm basing that not on timing, not on seeing exhaustion signals, but just the euphoric run we've had, the extension that we've had. I'm not an Elliott wave person, but it certainly seems like we've been in this pattern of it and have extended quite a way. So at some point we have to correct, we have to give back some of those gains, process those, digest them before we can go on. And I think that could certainly be in play, but boy, we're not seeing signals of that just yet. Let's look a little bit further. As I mentioned, energy, the #1 sector. Financials, #2, up 1.8%. If you want to know the story with financials, I would look at the chart of JP Morgan. This is one of the biggest weights in the XLF, which recently made another all-time high today. You can see the chart of JP Morgan. Again, it's round tripped from the January peak to the March low, tested that back here in January of this year, got above it, pulled back, did not even touch the 50-day, and now is rotated once more to the upside. So that looks like that. Berkshire Hathaway looks like this, also making a new high. Those two stocks looking like that is going to drive the entire sector higher, just because they're weighting in the XLF. They're two big weights in that particular ETF. But it's not just those two. I think if you look, down the cap tiers, if you look at a lot of different charts within financials, this is KeyBank, for example, one of the larger regional banks. Again, it's just sort of this nice orderly uptrend. And, again, while we're facing resistance, we're testing the January highs, totally fair. We're, just getting above them today. So that my assumption as always is, do we have staying power? Do we get above there and remain above them? But overall, I think that trend, I have to assume, is in place until proven otherwise. And I see the higher lows, especially on the pullbacks, which is why at some point in the near future, something like Key pulls back. I think you wait to see where we pull back to. We continue to make higher lows. The uptrend is in place by definition, and we're in pretty good shape there. That's all the time we have for the market recap. Need to take a quick commercial break. Back with Gary Dean from Sentiment Timing. See you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we break down the action of the markets using the charts. As a reminder, we love to hear from you. We're going to do another mailbag segment a little later in today's show. We'll do another one at the end of this week, and we'd love to answer one of your questions on the air. 3 ways to get your questions to us. Number 1, via email, thefinalbar@stockcharts.com, on Twitter @FinalBarSCTV, or on our YouTube channel. Just put a comment below the video that you're watching. We'll gather all those questions. Hope to answer one of your questions in our next mailbag segment on Friday's show. I want to welcome on my guest joining us on the show again, Gary Dean from Sentiment Timing. Gary's coming to us from somewhere on the East Coast. Good to have you back on the show, Gary. Thanks for coming on.
Thank you, Dave, for having me. Last time I was on was August 5th, and we were kind of in this same type of situation where this market exploded off of those March lows, and it was going. And I think the last time I was on the show, I was showing similar charts where it was, we were looking for some type of pullback. And when the bulls are in charge, they don't like to let go. And I think we went another 3 weeks before we saw that quick 10% drop. And the chart that you have up right now is the bullish percent. And if you look, I believe I was on August 5th, and that's that blue line that's within that red square. And you can see there's what I look for is fractal patterns, and there was a divergence that was taking place. You can see the black line is following the bullish percent, and the red is actually the S&P. And we have, if you move over to the right a little bit, where we are right now today, we have that same type of divergence. And it's not the market has to go down right now. What I call them is warning signs or red flags. And as you were just talking about with the Elliott wave, I do follow it. I'm not one of the experts, but I do believe that we are in the later stages of this, and we are looking for some type of pullback. And it's funny that you mentioned that 3,200, because that's actually one of our first targets that we're looking at, is that 3,200 level on the S&P. And if you take a look at the next chart, I'll show you one of our reasons that we're looking that way right now. So this is our proprietary sentiment chart that Woody Dorsey does. He's my partner with Sentiment Timing. And if you notice on the chart to the left, the 98%, 97, and then you have that red line going across. The blue, say, line is the moving average on it. And when we get up to these levels, it is euphoric, and pretty much everybody is only looking up right now. And then if you kind of go over to the chart on the right, it's a little bit zoomed in. So you can see the fractal pattern on that is pretty much what is taking place right now, where we had the 98% bullish sentiment reading. We saw the moving average, the 6-day moving average on the sentiment starting to move down. And really what we'd be looking for is another pop higher. And if you go back to the left chart, right around that August, go to the first red over to the left a little bit more. Keep going, keep going. No, yeah, that box right there. That's pretty much when I was here last time. And we were looking at this, and you could see kind of this fractal pattern with where we hit a high with the moving average, came down and came back up again. And then that's when we had that little 10% correction that hit. So we're in a very similar type of situation right now as far as with sentiment. And as I've mentioned, just with the wave structure where it is, and the type of investors that are in there with a lot of speculative trading, just really has us looking for a test of that 3,200. We believe is going to be coming into play.
It's a great take, and I love what you're saying about the divergence with the bullish percent index. That's a great take on that. And the sentiment, I mean, we've talked about the euphoric sentiment conditions. Let's assume that the S&P does come off to 3,200, which, I mean, it's going to feel like a disaster scenario, although it's not that far away. But right. Let's say the S&P does go down to 3,200. What sort of tools would you use? Would you and Woody use to evaluate the market at that point? How do you determine if 3,200 is a viable pullback versus, leg one of a multiple leg downtrend? How would you sort of look at that?
Well, the first thing that seems to be magical is if you start seeing those the 1%, 2% bullish sentiment readings. Mm-hmm. So that means that nobody likes this market, and if it happens in a day or two, it's amazing. What you're anticipating to be a larger drop, and then you get a 1 or 2% sentiment reading, and next thing you know, the S&P is at all-time highs again. So people are, what I call it, the all-in, all-out environment where, everybody's in a buying panic, and then everybody's in a selling panic. And it seems like the people that are, kind of managing their emotions are able to take advantage of both ways. But the first thing that we look at is that we want to see the sentiment at low readings. And then from there, I'll zoom in on, say, a 60-minute chart from StockCharts.com and look for some divergences in the technicals, and then really just take a look at support levels. And if they hold, then if we make a short-term higher high, then we're considering that the downtrend is complete. And then there's times though we just get these bounces, but Woody also puts out some turn dates. So that's if it's lining up with the time aspect of what we look at, as well as sentiment, and then technicals, where we'd be looking at a major low coming in place. But right now, like I said, we really just take it one trade at a time, because looking at things outside of that of 6-12 months, it just seems like people are getting turned upside down, whether you're looking long or short on it. So it's easier just taking it a little bit at a time and saying, all right, if we get a drop down to 3,200, it's not that far down, but it's still almost 600 S&P points. And that's really the way that we look at it. We're looking at more of a swing trade of the aspect of the market. I hope that makes sense.
Absolutely. We'll have to leave it there, Gary. This was so good to have you back on. Thanks for walking us through your perspective. Stay warm, stay safe, and we'll have you again soon. All right.
Thank you, David.
That's Gary Dean from sentimenttiming.com. We've talked about the bullish percent index, and I love how we illustrated the divergences there. When I've posted the bullish percent index on social media, which I do occasionally, I've had people point out some of the divergences on there. And it's interesting to see, while breadth overall has been very supportive, you get that situation very similar to like the RSI. If you look at the S&P daily chart and look at the RSI, you can see that the index has been moving higher, but the momentum has been lighter every time, right? So every peak in the price is lower momentum. And I think that's similar to what you're seeing with the bullish percent index. Less and less stocks going back to a point and figure buy signal every time the S&P moves higher. That's more characteristic of later stage bull markets than early stage bull markets for certain. Great take from Gary Dean there. Let's continue on. Open the final bar mailbag. This is our opportunity to hear from you, answer as many questions as we can, and talk through some of the things coming up in your own process. Let's get to it. Question number one, dear Dave, shouldn't we be looking at commodities now? The commodity tracking index DBC is at a new high today. And I should point out, this is from about a week or two ago. I didn't get to this one before. I wanted to address it. How higher interest rates and the dollar are affecting them. The 10-year yield appears to be headed higher. So far, question asker, you're absolutely right, because that's certainly been the case. Maybe the commodities and the dollar can break the negative historical correlation with interest rates. So you're absolutely right. And what I would tell you is, I think boiled into your question, I think is one of the challenges you have when you look at intermarket analysis. And I know when I first read John Murphy's comments on intermarket analysis in the first book, I mean, I think it was in Technical Analysis of the Futures Markets or the Financial Markets, that, John wrote a little bit about intermarket analysis. He wrote another book all about intermarket trends. But if you ask him today, he will admit that, those relationships are not hard and fast, they're fluid. And so, talking with Bob Prechter about this as well, at times, you have this situation where we love to think about, all right, if interest rates are going up, that means the dollar has to be doing this, and that means financials have to be doing this, and that means gold should be doing this, and that, et cetera, et cetera. And, what I have learned over my career is that those relationships are fluid. Stocks and gold have essentially a zero correlation over the long term. It averages out to about zero. There are times when they move together to the upside, times when they move together to the downside, times when they are completely unrelated, times when they move inversely. And so assuming a one-to-one relationship between any two variables, I would argue is a fool's errand of sort, only because those relationships are not as consistent as we want to think so. So I would focus a lot more on the trends. I'm seeing the trend in bond prices lower. I'm seeing the trend in rates higher. I'm seeing gold prices going lower. I'm seeing stocks going higher. And that's sort of the relationship. And I'm also seeing the DVC in a nice uptrend, and I don't see that changing today. And so, again, later down the road, we'll be able to debate why commodities were able to go higher given all these other circumstances. I think that's the beauty of charts. You don't have to worry as much about why those relationships are what they are and why they're changing. Focusing on the trends is what's going to help you be in the right things more than anything. But you're absolutely right, and nice call on the 10-year yield. You're absolutely right. It's certainly gone higher in the last couple of weeks. Next question, David, any concerns on your part that some stocks might, under their own volition, be in the declining stat, but not get nudged up into the advancing stat, owing to obligatory index purchasing? And you're talking in particular, I think, about the advanced decliners. This is a chart we look at sometimes where we have on every given day what percent of stocks are advancing or declining on a certain day. And we also do the cumulative versions. Your question is, is there a chance that a stock would be on the declining stat, but got nudged up to the advancing stat because of index purchases? Absolutely. And, 10, 15 years ago, I was debating with my colleagues at Fidelity about the impact of ETF purchasing and flows and all of that on individual stock prices, because our game was stock picking. It was the Peter Lynch model of looking at individual names, and there's still a great value in that. Larry Tentarelli, who was on the show last week, does a great job of ignoring the macro perspective and just focusing on stocks. That seems to work very, very well. So I don't have a problem with that. We talked about what if how much of a stock's movement can you attribute to ETF purchasing versus just the company itself? And there's no easy way or clear way you would ever particularly know that. But having said that, I do think that's absolutely right, especially with larger liquid names that have to be held by a lot of ETFs. I absolutely would say that some percent of their general bias to the upside is on people buying passive products that have to allocate to those particular names. There's no doubt about it. And I think one of the things that is a potential concern is if and when we have a big unwind and stocks go lower, assuming, I guess anecdotally, you would think if that's a pressure pushing things higher, then stocks could be okay, but people panic and sell out of their ETFs, and that's going to cause more of a weight and be equally as impactful on the downside. Just in however many years we've been in an uptrend for 12, 13 years. So we haven't really seen that scenario yet. So my short answer is yes, I absolutely think you're right. And the problem is there's no real clear way to know what percent of that that you can attribute to it. Next question, David, you like the chart? I like the chart of the week, Take Two TTWO. That was something I put on my YouTube channel last week. Thanks for watching that. Do you think ABMD, ABMD, applies to this and will continue its uptrend? Let's look at that one. ABMD. So take two, if you know that chart, basically rolled over, broke down through, or testing its 50-day moving average, breaking down. This is as other stocks in the space like Electronic Arts, Activision, Blizzard, holding up a little better. With ABMD, I see what you're saying. I think, when I'm looking at this chart, I'm seeing a bit of a, what you might call a polarity, sort of this relationship between the August and September peaks and the lows we had from January, and right where we're at with the 50-day. I would argue we're at a really key support level for something like ABMD. Something like 310 holds. I think overall you could argue this is a breakout, a test of the breakout level, and then a next leg higher. We start breaking down through that support, break down through the 50-day, and I think very, very quickly, you start to have to be concerned about what might come next. Take two is a little different because it's just getting below its 50-day. It's not to those same levels. The characteristics are a little different, but that's what I would be looking at on ABMD for sure. Let's see. David, you did an interesting video last week on compare and contrast. Can you do the same for the October and November bottoms and tops for the S&P 500? Are there indications or signs that the October bottom did not have legs and was going to fall back versus the November bottom with the tops? Other than overbought RSI, can you tell it was going to be a top in October versus November? Great question. And there's this thing called hindsight bias, where the further things like that get in the rearview mirror, the more optimize you make your own analysis. So I would love to go back and listen to my own shows during this period. I'll tell you exactly what I said. Maybe that could be a subject for another sort of own up to your mistakes show, where we'll review some previous episodes and what I actually said. I don't pay as much attention to some of those things, but so what happened here? In the September period, I think when we made the new high, we pulled back. I think there was a very much a change of character. It was the first time we were below the 50-day moving average since the April breakout. And so I think that was certainly, leading me and others to think about the potential for much further downside, and looking down at some of these other levels, retesting the May low, what that might look like. When we rallied back and made a lower high, that was further concern. And then when we sell off again, it's all about, do we hold that most recent swing low? As I say many, many times, an uptrend, higher highs and higher lows, a downtrend, lower highs and lower lows. So the fact that we did not make a lower low was a nice thumbs up. The fact that this was now a symmetrical triangle when we broke out, that was the second thumbs up. And the fact that we broke above the swing high in September, that's what sort of added this in here. So, when we break down through the 50-day and then bounce up, I'm all about looking to the left and seeing where we're at relative to those key levels. And once we establish that range, we either break above the September peak or we break below the September low. And I probably would have said at that point, whichever way we would break out, I would assume that's the direction of momentum. And there we did it. It's interesting to note, we actually weren't overbought or oversold anywhere during that period. We're actually in a pretty neutral range, revolving right around 50. That's all the time we have for the mailbag. Sorry, we can't get to more. We need to wrap the show. 3 charts in 3 minutes. It's going to be more like 1 minute, but we're going to get through them. Here we go. Chart number 1, the Bullish Percent Index. My guest today, Gary Dean, did a great job of describing how they're looking at it, and I agree with his take. I'm interested about the fact that you're seeing lower peaks as the S&P is going higher. In general, when the Bullish Percent Index is above 70, that tends to be constructive. That tells you the bull phase is in good shape. We break below 70, that's often called a bear alert, telling you there might be conditions rolling over. We saw that in mid-January, really didn't materialize in much of a sell-off as we held at 3,700. Let's look to see what might happen on the next time we come back below 70%. That's the first level. Chart number 2 is the energy sector. I mentioned financials, energy. The top 2, energy was number 1 today on stronger oil prices. Both the XLF and the XLE have now created these beautiful basing patterns, these cup and handle patterns. Both of them measure much higher than where we're at, which tells me those sectors are in good shape. And I think the relative story on energy is what's most impressive, making a new 6-7-month relative high today. Finally, consumer staples. If you want to know a sector I would be leaning away from, it's something like this, with an established pattern of lower highs and lower lows. Lean into what's working, lean away from what's not working. Folks, that is our show for today. Special thank you to Gary Dean from Sentiment Timing joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.